Every single day, there are invisible levels in the S&P 500 where price gets pulled toward a specific number like a magnet, and other levels where price gets violently repelled. Most retail traders have no idea these levels exist. They think the market moves randomly, or they rely on support and resistance lines they drew themselves. But institutional traders and market makers, they know exactly where these levels are. And they're created by something called gamma exposure. In this video, I'm going to explain what gamma exposure is in plain English, how it controls the way ES futures move every single day, and how you can start using this information to make better trading decisions. This is episode 1 of a 5-part series. Let's start with the basics. Gamma is a measure from options pricing. Specifically, it measures how fast an option's sensitivity to price changes itself changes. But here's what actually matters for you as a trader. Gamma tells you how aggressively market makers need to hedge when price moves. Think of it like this. When you buy an option, someone has to sell it to you. Usually, that's a market maker. Now, the market maker doesn't want to bet on direction. They want to stay neutral. So every time price moves, they have to buy or sell futures to stay hedged. Gamma tells them how much. When gamma is high at a certain price level, it means there's a massive amount of options interest there. This hedging activity literally moves the market. So gamma exposure isn't just some academic concept. It's the mechanical reason why price behaves differently at different levels. Every day, there are millions of options contracts open across different strike prices on the S&P 500. Each strike price has a certain amount of gamma associated with it. When you add up all the gamma across all the strikes, you get what's called the gamma exposure profile. This shows you where the biggest concentrations of hedging activity will happen. And notice how gamma tends to concentrate at round numbers. That's because most options trading happens at round strikes. And that's why you'll often see ES futures gravitate toward round numbers and then pin there. It's not magic, it's mechanical hedging. Now, this is the most important distinction in gamma trading. Positive gamma means market makers hedge by going against the move. Price goes up, they sell. Price goes down, they buy. They're constantly pushing price back toward equilibrium. This creates a slow, grinding, mean-reverting market. Negative gamma is the opposite. Market makers hedge by going with the move. Price goes up, they have to buy more. Price goes down, they have to sell more. They're amplifying every single move. This creates fast, volatile, trending days. The kind where ES rips 50 points in one direction and doesn't look back. There's a critical line called the gamma flip level. Above this line, expect mean reversion. Below this line, expect amplified moves. Knowing which side you're on completely changes your trading approach. Let me show you this in action with what happened in ES futures this week. On Monday, ES opened above the gamma flip at 6,800. Price spent the entire morning in a tight 15-point range. That's positive gamma doing its thing, absorbing every move. Then on Wednesday, price broke below the flip level, and within 2 hours, ES dropped 40 points straight down. Negative gamma kicked in and amplified the selling. You can see how price respected these levels almost to the tick. This isn't a coincidence. It's mechanical hedging in real time. So here's how you can start applying this right now. First, know where the gamma flip level is each day. Second, identify where the highest gamma concentration is. And third, pay attention to options expiration dates, because that's when gamma effects are strongest. In the next episode, I'll go deeper into how market makers actually hedge, the specific mechanics that create these price movements. If you want to understand why the market moves the way it does at an institutional level, you don't want to miss it. Subscribe and hit the bell, and I'll see you in episode 2.